So normally, if someone calls you cheap and overweight, that's a huge insult, and that's not a nice thing to say. However, in the world of the stock market, those words should ring sweetly in your ears, and that's certainly the words that JP Morgan has been using against the UK stock market just a few days ago. So their research teams have been crunching all of the numbers, and they've come back and said that the UK is now overweight and a good place to invest your money. They used to be more favourable toward the FTSE 250, so those set of smaller companies for their agility and their growth potential, but they've now changed their tune and swung the baton all the way on the other side, and have now said that the FTSE 100 is the place to be. Well, why their sudden change of tune? Well, I'm going to run through those reasons just now. I'll also show you all of the stocks which they've picked, the 25 different companies on their watch list, so that you can take all this into consideration and maybe add some of these to your shopping basket for the next few months. So their change of heart comes down to a couple of very key points. Firstly, they note that the FTSE 100 has a lot of global companies and a lot of global exporters on this list. And those global exporters currently benefit from the weakness in the pound, especially against currencies like the dollar. Weirdly, for our FTSE 100 shares to do well, we actually want the pound to stay pretty weak, unfortunately, because that means that exporters, when they're selling to countries outside of the UK, get more of their money and they're more inclined to spend that money and get more for their goods when they buy. And as you may already know, the FTSE 100 actually generates the vast majority of its income outside of the UK and outside of the pound, so this exchange rate is really, really critical. Secondly, they've also noted that dividend yields are very, very strong, certainly when they compare that over to the US and the rest of the European market, so big tick in the box there. And finally, they've seen a key indicator happen saying that the inverse correlation between interest rates and stock prices has now been broken, so that's a huge bullish signal for JP Morgan. Now, while the world gets excited over lots of super growth stocks in the States and ones which generate a huge amount of hype, get huge share prices, but without actually generating any revenue and losing lots of money, lots of companies on the FTSE 100 slowly but surely grow their revenues, generate huge amounts of income, and almost like the tortoise and the hare, they do end up winning that race over the long period of time. Can't believe I'd use a reference like that. That's a really old one, isn't it? As I've said many times before on this channel, of course we all know how important it is to make sure that we've got a well-balanced, diversified portfolio, because although we can look back at the past and see where the growth has come from, we've got no idea where the next growth is going to come from, where the next global returns are going to come from in the market. Having the FTSE 100 as part of your strategy could be a good part of this option, but let's not get too excited and too carried away, and just reflect on the fact that the FTSE 100 in the UK market only makes up around 4% of that global equities market, so don't get too carried away. Anyway, what did JP Morgan have to say, and more importantly, what companies did they say that we should have our eye on right now? Well, I'll pop all of these up on screen now. So they chose 25 different companies. We've got ITV, WPP, Babcock, Lloyds, Barclays, Travis Perkins, Melrose, IMI, Victrex, Intermediate Capital Group, Shell, Tesco, AstraZeneca, Taylor Wimpey, Royal Mail, Glencore, DS Smith, British Land, Grainger, JD Sports, Reckitt, Imperial Brands, Britvic, BT, and Centrica. And now breathe. So that's actually a pretty well diversified list. You've got quite a lot of different companies there who do lots of different kinds of things, everything from online retail to mining to telecoms. Gives you quite a nice balanced, diversified portfolio. The only stock I actually hold personally, just to show my own biases, is a very small amount of Tesco on that list, which is in my dividend portfolio, which I recently started, and you can check out the video maybe here or here. I'll certainly leave it in the description below. I'm building out a dividend portfolio at the moment, just really to see how big I can potentially make it over the next decade or so, and potentially end up paying some of my own bills. Anyway, just for a quick reference, I've done all the numbers for you and grabbed all of those 25 stocks and put together their 12-month performance and 5-year performance, so we can have a very quick look and a very high-level overview of actually what stocks they've picked and how well they've done historically. So here are all those stocks listed. I've got 2 columns on this sheet, the 12-month performance and the 5-year performance. Anything which is positive, I've highlighted green. Anything negative, I've highlighted as red. Just bear in mind when we're looking at these, I've not taken into account any dividends here at all, so you'll have to take that into consideration if you see any names which maybe haven't performed as well. But we can see the kind of pick of the bunch here is Glencore and IMI, certainly in terms of the 1 year, but overall JD Sports smashing them all out of their water with their performance. 40% up on the year, 277% across 5 years. Now those are some really nice market beating returns. The sportswear retailer has managed to stay very current, of course, driving both retail sales and online. And certainly, I don't know anything about you, but when I'm at home, I like wearing my jogging bottoms. AstraZeneca is certainly another good pick here. Not massive gains in that 1 year, but a really healthy 5-year return, and don't forget they're also a good dividend player too. So that 117% return there is pretty much in line with what the S&P 500 has given, but you've got the bonus of getting those dividend payments too. Who says that big companies can't also grow and potentially beat the market? So what else does this information tell us? Well, if we just look very quickly at this list again, we remind ourselves that in this year, we've had a crazy run on lots of stocks, and it almost isn't one which you could have picked a loser in. However, we have to go back a few years to actually see what the real long-term performance of these stocks has been, and it does remind us, certainly as investors, how difficult it is to pick those long-term winners. And this last year and this bull market we're in has really treated people very well indeed, and made people get very much overconfident in their stock picking abilities. So are these stocks cheap now and fair value? Well, I haven't really got the time to go into the detail of 25 different stocks. Potentially that might be something we can do in a future video. If there are individual companies that you'd like me to do a bit more of a deep dive on, it's certainly something I would look into. Just let me know in the comment section below if any of these stand out for you, and certainly let me know in the comment section below if you've held onto any of these for a long-term period. Be very interested in that. On a wider note, what would be the best way to go ahead and buy these stocks, and what would be the best way to make sure that you can invest your money over a long period of time? Well, of course, you can just buy these individual stocks and just put all your money into them and go onto your favorite broking platform, sit back and let time do the rest. However, there are a couple of different ways which you might want to consider if you are looking to get into the FTSE 100 market. Firstly, I did a video covering this just a few weeks back, looking at some of the best ETFs that you can buy, which hold the entirety of the FTSE 100. That way you don't have to go stock picking and don't have to do too much research in the sector. Again, I'll link that video below, potentially here or here. Who knows with these cards? I can't tell, left, right, who knows? Another way you could potentially do it, as there's nothing stopping you doing this at all, is dollar cost averaging into those individual stocks and shares too. Nothing says that you have to just lump sum and throw all of your money into a bet at once and hope for the best. You could potentially choose your stocks, dollar cost average into them maybe every month or every week, and only change if the fundamentals of the company change, because in the long run you're not necessarily bothered about that initial share price. It's all about that long-term gain as a value investor, which I know has really gone out of fashion recently, but eventually I'm sure value will catch up. But I've got no doubt that value investing will slowly catch up again, and those growth stocks, as exciting as they are, and I hold many of them myself, we know that they have to come crashing down and return to that mean average eventually. Certainly if you think something's cheap on this list, do all of your own research. Remember, I'm not a financial advisor by any means at all. I never pretend to be, so please do all of your own research out there and make sure you look after yourself out there. Anyway, with all of that said, who knows what the future will hold? I just wanted to share some of the information that JP Morgan had said to the market and make sure we give a little bit more optimism from the usual doom and gloom headlines that we get here in the UK. So I hope that's been useful for you. I do think the UK stock market is quite a nice defensive play. There's lots of sustainable dividends in there, some companies which are going to grow every single year, and some very nice industries, certainly in the consumer staples and things that we require regardless of economic conditions. It's certainly no get rich quick scheme, and no one's going to get rich overnight, but this one could be a nice long-term play to have as part of a well-diversified portfolio. Anyway, as I said again, make sure you do all of your own research. If you found the video useful, please drop me a big fat like, subscribe for many, many more. Thank you so much to the hundreds of people who've joined me so far. I'll see you guys in the next one, and as always, happy investing.